Welcome to today's webinar program entitled The Economic Outlook Ahead, What It May Mean for the Insurance Ecosystem. It's a collaborative presentation of the Institute's Griffith Insurance Education Foundation, the Insurance Regulator Education Foundation, often referred to as IREF, and the Cady School of Insurance and Risk Management here at Illinois State University. I'm Jim Jones, the Executive Director of the Cady School of Insurance here at Illinois State University, and your moderator for this session, which features the insights and expertise of Dr. Michel Lénard, Chief Economist and Data Scientist, Head of the Economics and Analytics Department at the III, and Adjunct Faculty Member with the New York University's Economics Department. To learn more about Dr. Lénard's background and research interest, please visit the Griffith Foundation's website and select the link to this program registration page where you'll find biographical information. So in late March, Dr. Lénard sat down with my friend Frank Tomasello, and I know some of you were at that. They were discussing the impact of the current economic conditions on insurance, offering a thought-provoking overview of regulators with respect to the current conditions. So it's a delight to welcome him back to our microphones for a more forward-looking outlook discussion today. Michel, thank you for joining us.
Thank you very much, Jim. It's a pleasure as well to be here today. Indeed, Frank's request today was for me to build on last week's, or a couple of weeks ago, and to look forward in time to the changes in the insurance ecosystem from an economic standpoint, from a fundamental standpoint, and ask big picture kind of questions. So it's a bit of a crystal ball, but an educated, structured crystal ball. So let's get going here. We're going to have the presentation as usual, and then a Q&A as Jim was just mentioning.
And let me interject for those who may be joining for the first time. For those who are joining from the previous times, you'll know this. But we ask the participants to ask any questions using the Q&A feature that's in the webinar interface. And just so you know, your questions will not be visible to other attendees. So you can, ask questions anonymously about what you would like to see. I'll review the incoming questions, and then we'll pose the question as time permits during the final segment. Today's program is being recorded and will be available on demand and playback in the days ahead. And to be able to access that, again, you can go to the www.griffithfoundation.org website. So and in keeping with the respective missions of the Institute's Griffith Foundation, IREF, the Cady School, today's program is purely instructional in nature and does not support any issues. All right, Michel, let's hear what we have to say about about the outlook ahead and how that might affect the insurance ecosystem.
Absolutely. Thanks, Jim, for that important notice there. Always very, very key. So I've divided the presentation into three sections. First, we're going to look at inflation scenarios, growth scenarios, and then finally, we're going to try to look at those in the context of solvency and economic viability. Just before we dive into this, one of the key elements here is what kind of world are we looking at? And there's a couple of trends that are going to inform this conversation. One has to do with inflation, where inflation is getting better, but let's remember we're still around 5%. It's still about three times as high as what we've had for many years until the pandemic, and we don't expect that to get better. It's getting a bit better right now because it's decelerating, etc. But we're going to enter a world for the next 5, 6, 7 years, most likely, crystal ball, most likely to be of high inflation. So that's kind of the context there of our inflation outlook. And what does that mean for insurance? And then the other component is that we also see a world of reduced growth, especially in the context of this high inflation. So again, what's the implication there for that? And then again, relating it to solvency. Okay, let's dive into this. As I was saying, the the post-pandemic socioeconomic trends, when we try to look at economic fundamentals, at socioeconomic fundamentals, at political economy fundamentals, we have to really go from the economics to the demographics to the sociology. And that's traditional economics, by the way. Traditional economics really looked at these dynamics between human interaction, between groups, polities, and so forth. More econometric, modern economics, let's call it, is about what we're familiar today, about all these numbers and so forth. But it's quite exciting once in a while to be able to go to this classical framework of economics. And that's a bit what we're doing today, looking at how do we change these building blocks. And then, of course, all of these economic and econometric statistical assumptions as a result of that may change. Events like a pandemic, these epochal events, they rarely bring about a new world. Things don't change drastically, but sometimes they accelerate. I think there's a quote out there is that history doesn't repeat itself, but it does mimic itself, but it also jumps. And I think what we had here, one could argue, is that these trends that were happening, socioeconomic, political, economic trends, are accelerated. Let's look, for example, at the use of technology. Let's think of the use of technology and what we're doing today, this webinar. We might have tried to have it in person in the past. We certainly would not have had maybe as many as we do now. Everyone now understands how to use the technology. It's become much more available. That might have taken 5, 6, 10 years, maybe a generation for folks who really learn to this. Look at working from home as an accepted new normal. Again, that might have happened, but it might have taken much longer. So when what I'm talking about today, in many cases, are trends, socioeconomic, political trends, economic trends that accelerated. One of these is what I refer to as network geography. In the United States, folks move a lot, especially compared to other countries. And that has implications for economics. And we in the insurance world very much think about inflation and growth traditionally in terms of states. It's what economists do. We have the unit as the state within the country. GDP is nationwide. Then we look at the state. And within the state, we look at cities, rural versus urban, and so forth. That's changing, and that has been changing. You may have heard this conversation about the emergence of networked zip codes, about how folks would think, well, I'm going to move from a high cost area to a low cost area. They would think a state, high cost state to a low cost state. What's happened more recently in the last 5 to 10 years, and now it's accelerated, is that if one moves in these network zip codes, these network environments, the cost differences aren't that high. It's no longer about one state versus the other. It's more about downtown areas versus suburbs versus exurbs. The exurbs here component, of course, being a big development of an acceleration in the context of the pandemic. So we're going to talk a bit about that, what that means for pricing, for inflation, and for replacement costs in our context. I've mentioned the hybrid component. Excuse me. One of the areas here has to do with how do we create products in the insurance world that traditionally have been commercial on one hand and personal on the other hand. Now we have a lot of hybrid. Think of it as the Uber model, where you have a car that's a personal car, and at times it's a commercial car. Now our homes are becoming like that. Again, what does that mean? This is a demographic trend, it's an economic trend, it's a transformation of the role of employment, how we make money, etc. And it was already happening with Uber, but what does this mean now in terms of this acceleration? So, and then there's also, if you add to that, the fact that each generation consumes differently, lives differently, and you think of this epochal change, generational shift between baby boomers and millennials. I'm an Xer, and we're kind of, as the X says, we're a small generation, we're in between, so we had a more limited impact. But these the two largest generations in modern history really going one to the other, and they don't consume the same. They don't live exactly in the same way. They buy homes, but they don't buy the same kind of homes. They don't buy them in the same place, not just because of taste, but also because of the economic ecosystem. And as a result of that, our insurance products have to adapt, have to adjust. They're going to change. And also as a result of that, it has implications for solvency, for growth of the insurance industry, for growth of different products, for diversification, et cetera. So that's the world. Those are kind of the big picture trends that we are going to use today to inform our conversation. So again, crystal ball, but a structured crystal ball. And a crystal ball really that doesn't come up with entirely new concepts. It builds on what's already been happening. It identifies a few that, in our opinion, may be relevant, directly relevant to transformation in the ecosystem and how it will impact insurance. There's many others. This is not aiming to be comprehensive or anything. And it's also not saying this is going to happen. But I think this is us saying that these considerations are happening and they're likely to continue, and they're likely enough that we need to think about them in the context of how one regulates, in the context of how one oversees the industry. So we're going to start with inflation, and I'm going to have a little water if you don't mind. I have a glass of water somewhere, but I don't know where I've put it, so I have the bottle in front of me. Great. So first, the big picture of the economics. And if you listen to the twin presentation to this one on where we stand right now, we have an environment where inflation as a whole has been historically elevated to 7 to 8% and so forth. We're coming down here. But I want to show you 2023. We're still twice as high where we were. And even if we look at these numbers for 2024 and 2025, these are very optimistic numbers. They're based on the Fed, and they're very optimistic. We may not get to those numbers, but even if we do get to a 3.0 and a 2.5, these are going to be the basis numbers. This is going to be kind of the low frontier, the low border of this. And then you have, the possibility of easily reaching 5%. Why is this important? You may say, we know the numbers traditionally it's around 2%, 1.9, maybe 2.4, 2.5 is not that big of a difference. If you compound those numbers over 5 and 10 years, going from a 1.8 to a 1.9 to a 3, or even to a high 2s, you actually get twice as high the level of inflation. And compounded, it makes for a big impact. Just think over the last few years, for example, auto prices. I was doing the numbers yesterday with a colleague of mine, and on average, auto prices have gone up about 1%. It's really not that actually high how fast vehicle prices go up. It's a little below inflation. So over 3 or 4 years, we're around like 2.4%, something like that. But in the last few years, because they were much higher, we're actually at 24 in the 20% area. So this compounding interest it's the same as compounding interest. This compounding inflation rate is very important. And once you have these elements, it just really changes the way we save, the road, et cetera. So this is the big picture here. And of course, there's a relationship, as you can see here, between inflation overall and inflation and replacement costs. So for us here in the industry, in insurance, we care about inflation as a whole, but we especially care as how inflation translates, how inflation informs replacement costs. And those of you who've been following what we do at the III, in conjunction with Griffith quite often, this is a recurring theme of ours, especially in the last few years, where replacement costs have been a multiple of overall inflation. So structurally higher P&C replacement costs. In the last years, during the pandemic, what we've seen is that replacement costs for P&C lines at times have been as high as twice as much as overall inflation. Inflation nationwide peaked around 8% across goods and services. For insurance, replacement cost increases year over year as percent peaked at around 16%, twice as high, almost twice as high if you look at the exact numbers. Now, not only is this considerable, but it also speaks to specific goods and services, housing, autos, vehicles, and so forth, construction material, which we repair and rebuild. This is the core of what we do. So if we look forward and we think of these larger economic trends, this ecosystem we're referring to, housing, just by definition, comparatively, is becoming more and more expensive. These are finite. There's a finite amount of space. There's a greater and greater competition for that space. That's why folks are moving from downtown areas to suburbs and exurbs and so forth. But construction materials, lumber and so forth, even if we're able to generate recyclable materials and so forth, which of course is happening, but even in that context, population is growing. Population tends to grow in an exponential way. It's not a straight line. And then on the other hand, growth, the land also is a finite available resource. So you get in the position where supply and demand being what it is, construction, housing, residential, and commercial almost by definition has to be an environment where it's growing at a faster price. But I'm not just talking about the resale and the purchase price of a home or a building, because that we don't insure, but the underlying materials. And what we've seen in the last few years, because of the pandemic, with dislocation in supply chain, that led to these amounts really twice as high. We're not going to be twice as high in terms of replacement costs for housing and so forth for the next several years, but we will be significantly higher for construction replacement costs, property replacement costs, compared to overall inflation than we've been. So that leads us to this theme that's going to come back and back here in my presentation of what does that mean for the way we think of what an insurance premium ought to be. If you're insuring your property, let's say you have 1% of resale value, which is a random number. Well, is that 1% of replacement cost? Now, that 1%, we're maybe, let's say, comfortable with that. We're used to it. Recently, it's been increasing a lot, but it's still in the same range. But moving forward, after year and year of replacement costs being significantly higher, compounded year after year above the overall rate of inflation, what happens to that price here? What happened to that, the rate setting process, especially if we think of not just economic components and variables and ecosystem, but also this overlay of extreme weather events, this overlay of a variety of other structural considerations. So that's going to be a theme. And you're going to see that a lot of these areas that I'm going to talk about today, it's going to be about what happens at the end of the day to the way we price and the way we think about the relative price cost of insurance, whether it's for housing, property, commercial homeowners, or whether it's for other areas such as auto and social. So let's go to this next area, the water. Okay. Now, I've mentioned, staying with inflation, housing, commercial, and real estate going up structurally above and beyond inflation. But where are we building? Traditionally, regulators, but also carriers and so forth, obviously want to diversify the risk. And regulators looking at it in terms of an oversight, think of how we diversify as a way to protect our surpluses, protect our industry, sound risk management, and so forth. So we've been diversifying as an industry by areas, by states, by industries, and so forth. Let's focus on this concept there of geography. Network geography, I've mentioned. So we used to diversify across states, but now what we're seeing, one of the ways we diversify was across states in terms of better allocating the risk. That's what insurance is. We just pool, quote, and as a result of that, the risk is spread and diversified, and the overall asset is more stable in that regard. That's the core of what insurance and so many of the portfolio theory and so forth can do. So in the context here of this way of diversifying our costs, narrowly defined across geographies, across states, that the nature of geography is changing. As I mentioned, a state that might have been across the board considered a lower cost replacement cost state may no longer be able to be qualified that way, because now we're going to have to think in terms of urban, which we already did, but suburb, instead of rural and urban, now we're shifting to this downtown, suburb, and exurbs. And even within these, we're going to have very high cost areas and so forth. So, and that's not in and by itself a problem. In many ways, we can say, well, now we can diversify and better allocate the risk in an even more granular manner. And that's great, but it's different than what we've done so far. So there needs to be a rethinking there a bit about that. And we need to get the data to do that. And we need to work with regulators as an industry to say, oh, this is going to be a bit different here. And making sure that this process is equitable and is fair and is economically viable and is statistically sound. So what we had here, just so to help you along so that we all move forward together, we have these considerations, these trends, cost and so forth, and the intersection of that in geography. And how do we adjust as an industry? How do we think about our risk assessment and our risk models and our quantification and our diversification to address that? And how, at the end of the day, does that allow us to look at our overall pricing. So, transitory, I just wanted to show you here some of these costs as they stand. This is for the last few months. You can see commercial property in the first 3 months of the year has actually done well. Prices have actually come down because of so high, but you can see they're below the CPI this time. But I just want to convey that if you're looking as regulators, if you're looking at the industry, or if you're an industry participant and you're looking at this, you really want to think about this is the last 3 months. And inflation in the last 3 months have been decelerating overall, and it's been decelerating faster for the industry, for P&C lines, for homeowners, because it had gone up so high. If you think of auto, for example, auto at one point was up 40% for used autos year over year. So of course it's going to come down, but we're not expecting this to stay. And that's really the important thing here. So if you're looking at rate setting, if you're looking at the numbers and you're seeing these trends right now that are welcome, I think everyone is as consumers, as buyers of insurance, as regulators, and as carriers, we're all happy to see that. At the same time, it's too early to think that this will become the trend. And on the contrary, from a structural standpoint, it's unlikely to be that way. And that's why I put that slide there. Okay. Stuff is going to get more expensive, and it's going to get more expensive even more so for those goods that from a piece standpoint we repair and rebuild. And concept of geography is going to change and how we can diversify and so forth. That's the kind of where I wanted to focus from an inflation and cost standpoint. I want to talk a bit about growth now and where the growth is going to be. Again, we in the industry quite often, and folks in general, think about growth on the basis of a state, of the region, the South booming and so forth, or Florida, some of these states where folks are moving for a variety of reasons, or certain parts of the state, et cetera. But how do we think now about these elements? Okay. So the first thing is nationwide, traditional economic theory tells us that when inflation is higher, growth is going to suffer. Now, that's been the case in the last 50 years. And that's why there's been such an emphasis on price stability and inflation. But there's a layer above that. It's not just about growth. It's also about generational wealth transfer. If you have a generation, especially when there's a large generation that comes about within a few years, there's an element there of preserving the wealth aggregation, the wealth building of that generation, so that going into retirement, there's an ability there for that generation to live well and so forth. And that's a public good. It's important to have that. What we've seen, though, is that there's been a great deal of emphasis on price stability over the last 30 years, someone could argue almost at the extent of processing debt through inflation. Because inflation can be a way of processing debt, especially when debt becomes unsustainable. So if you think of this whole conversation about debt and the debt being very large and so forth, well, one of the reasons is that we've kept inflation so low, so we're not eating away at the debt, which quite often is the way throughout history that debt is dealt with, not just through repayment, but when debt becomes unsustainable, inflation normally follows to address some of that. So we're in a position here where there's been a lot of emphasis on price stability. And the issue now is that inflation is catching up for a variety of reasons. And again, this was structurally in there. The ecosystem was built in. And then the war, Russia's invasion of Ukraine, and then these other considerations, COVID, have accelerated that. But because of all of this, we're at a juncture here where we expect to have higher inflation, as I discussed. We should probably, on one hand, expect, economic theory tells us we're going to have lower growth. It could also go the other way, and that becomes a social, a policy, a political decision of how do we handle growth, tax policy, different industrial development, and so forth. But right now, all things being equal, if we keep the political consensus, the political, economic, the regulatory consensus at a federal level and other levels in terms of the overall economy, not just in terms of insurance here, with this higher inflation, we should have lower growth than we've had, short of any significant changes. So for us, it says we're going to grow less rapidly, and we're also going to grow differently. So let's talk a bit about that now. Next time I'm going to have my glass right here. One of these areas that growth is where it's going to be different has to do with how we live and where we live. I've already talked in the first section about the cost of housing. Well, the cost of housing, the location of housing, it's the flip side of the same coin. So there's that element, but it's also as the network geography is emerging, as we work from home, the way we relate to space, to geography changes. Like I'm speaking with you, you didn't have you maybe in the office, you didn't have to leave home, maybe even I'm at home here. And that's that's my background there. It makes this look like an office. But the issue there is that we're moving away from this is where we live, this is where we work. We have emerging, we have a blurring of the boundary between the private and the public, between the private and the commercial. Now, hybrid living in terms of, we used to talk about a building on the first floor, business, second floor, residential, and so forth. Well, that's been around since the Romans. But now what we're looking at is within the same apartment. So again, there's nothing new there. It's been around for a long time and there are trends, but we're seeing this accelerating and becoming more and more relevant to us. Why is this relevant? Well, this is relevant partly to this conversation because in insurance, when it comes to P&C lines, one of the ways we diversify and we think about housing and dwellings is commercial, residential. Hybrid, at times, we have policies for that, but it's the exception. We think about condos and co-ops, and that's sometimes as complex as we get in terms of that. We're going to have more and more of this. How do our policies, the Uber model for cars, I was referring to, something that at one time is private, something at one time is commercial. And as with geography and inflation and this concept of thinking of urban and suburban in terms of cost, now we have the diversification that came with that. Now we have to ask ourselves, well, how do we diversify? One year the commercial side is going well, one year the personal lines are doing better. Well, suddenly they're going to be correlated a bit more because there's not as much of a boundary between them. Nothing wrong with that in and by itself. Actually, there are opportunities with that, product innovation and so forth. However, it is a different type of environment, and we want to make sure, and this is why the regulatory component comes in, we want to make sure that not only from a business standpoint, we take advantage of that, from an industry standpoint, we meet that demand, but also that we don't lose the diversification benefits of that, because diversification and the pooling of risk is at the core of prudent risk management, and it's at the core of how we provide the product on an economically viable manner and at a premium range that fits within the overall financial supply chain. Okay. The same thing with cars, and this one, I think I keep referring to the Uber model. So there is this divide between cars being personal and commercial, vehicles being personal and commercial. But we're also, and this is a bit more, everything else is basically happening already, and you're going to say, yes, Michel, we see that it's happening. So this is a bit more crystal, or more crystal ball than the rest. The one area there is that, and we don't know yet if that one's going to happen. But there's a lot of conversation around whether the ownership of car, the ownership structure, not just for Uber, the Uber types, but the ownership structure is going to stay the same. Are we going to move into a world where ownership is going to become shared, the share ownership model? If we look at a tighter geography, if we look at more remote interaction and so forth, do we need the car in the same way? Do we want to own the car in the same way? And that's already happening in urban settings. If you live in Manhattan, it is more economically viable to use a cab when you do need that. Well, obviously public transportation first, but if you need to go to individual transportation, it's more economical to use a cab than to have a car that stays idle in the parking for part of the week. Now, as we go into this network geography, into this network hybrid world, that trend may expand. Also, we're tighter and tighter. It's going to be more and more people. What does this mean for the way, as an industry, we think of about auto and vehicle insurance? How do we deal with concepts such as the policy, the coverage follows the vehicle? How do we deal with multiple ownership, et cetera? And then how does that impact, again, our diversification and so forth? How does that impact the product? What if we move in an environment, for example, where renters is the norm on the housing side? I'm not saying that, probably not happening, but what if we move in an environment where the majority of cars are owned on average by those who drive them? not an issue. We have products to do that already. But again, the underlying data is going to be different. The underlying pricing is going to be different. Opportunities, greater granularity, and so forth. Do we think of, and that's, we recognize this combination of telematics. Do we look at, do we follow the car, the highways, usage during the week? But if you have a car that's used by 2 or 3 or 4 or 5 people, how do we price that? So again, opportunities, but a necessity to understand, to have the data, and so forth. Where do we stand right now? This is kind of a recap of bringing back where we are right now as we're looking forward in the crystal ball, but also thinking of right now. So right now we're looking at growth in our industry, P&C segment of the insurance industry being below zero. We're contracting a bit, and we're looking at it being below the GDP. This is, by the way, in the first 4 months annualized. So starting in December up to now, and annualize if this were the year. That's the way these numbers are. Traditionally, we would be in a place in the industry where we would be growing much faster than the overall economy, because the economy had somewhat of a contraction in Q1 of last year, going to Q2 and Q3. And insurance traditionally lags going in a contraction, so we do a bit better, a bit longer. But then on the other side, when we exit a contraction, a recession, we continue, we lag, we don't do as well for it, and then we catch up. Now, because the economy turned around so fast, and a lot of this has to do with the Fed monetary policy, and you can look at some of our writing and research in that area. But because of that, without going into whether that was the right policy and so forth, but because of that, factually, we didn't have our we didn't have time to have our cyclical rebound following Q1, Q2 correction last year, and that is concerning. Again, we're able to manage. We do it, prudent risk management, but that is an issue about our combined ratio and our overall performance. And the reason I mentioned this here is because if we're looking in the crystal ball, but also looking right now at what's in front of you on your desk today, tomorrow, Monday, etc., when thinking about rates, about diversification, about stability, financial sustainability, and so forth, we're seeing inflation getting better. Don't buy it, not yet. Think of the structural reasons why it's not going to stay that way, even if it materializes. But then on the growth side, we're not doing well right now. So you know, those two elements there is that there's a lot here. It's kind of a time to see the glass as the bottle as half full. It's kind of that where we are right now, sadly. Okay. We're doing well on time here. We'll have time for some questions. So that was one of our goals today. The economic viability. So I've identified here, I've discussed the world as it is, as it's been, and some of these changes that are accelerating as a result of the pandemic and some of these trends and so forth. Now, what were they? They were this issue of geography, network geography. Why do we care about that? We care about that because suddenly we can't necessarily diversify in the same way. We can't necessarily look at pricing differences in the same way. Again, not an issue, but a different way of approaching it. Do we have the data for it? What about equity, etc.? And then we're looking at the other side at the patterns of growth as well, and how growth is going to be different and how that's challenging. A lot of that is challenging the divide between, the boundary between commercial insurance and personal lines. And how, again, not an issue in by itself, but certainly a consideration that will require better data, and also that needs to be framed in the context of equity. And then finally, but then we get from all of this, okay, the product is changing. The way we diversify and we pull the risk is changing. Well, that speaks directly to our financial positions. That speaks directly to how we price the product and how we build our policy, maintain our policyholder surplus. So let's talk a bit about that. You know, I remember at one point putting a policy, working with brokers when I was on the brokerage side of things as an economist, and there to price the risks and so forth. And I remember folks on the private equity side saying, oh, you have a 1%, let's say, credit policy, and a 0.5% spread on that. That's very affordable. Insurance is an affordable product because we have to be 2, 3, or 4, or 5% when we're looking at lending. Well, one of the reasons is that the underlying economics traditionally of insurance as a product, the commitment isn't the same in terms of capital. So traditionally, thanks to our diversification and thanks to the underlying reality of the product, the cost of insurance has always been somewhat below the cost of insurance capital, as one could refer to it, from the insured standpoint, and therefore all the way up to the provider of that capital. The return is already always below that of overall capital, liquidity, lending specifically. Now, if we look at these trends here that we've been discussing, we have on the growth side, different growth, on the inflation side, different inflation patterns. And that's taking away from our ability to diversify. It's forcing us to rethink of it. But we also, and a lot of what we repair and rebuild is increasingly expensive, longer trend. But that's the economic, socioeconomic, political economy ecosystem. There's a big one around that, which isn't the point narrowly of this presentation, but that looms over all of that is extreme weather. And extreme weather events and their pattern. They also used to be, we used to think about them much more about Florida's problem or coastal area. Well, now we have California and the wildfires. We have tornadoes. Extreme weather events are, I'll know this isn't the point of this presentation, but very briefly, just to refer to the macro ecosystem around this conversation is that overall risk for the industry is going up. And this is adding to pressures about liquidity because these events really, at the end, they can trump all of what we're talking about. So if we're ending in this environment, we are seeing that there are structurally unsustainable combined ratio. Look at the situation in Florida and think of Florida as a harbinger of things to come. The problem is that it's not just about Florida and extreme weather, is that there's also all of these other trends that are challenging us. That is the focus for today. But we end up in a place where how much are we going to have to charge for this product? We've had several years of historically higher increases in rates in many of our lines. Now, I do want to mention that on average, replacement costs have increased twice as high as rates. So if we're looking at vehicle insurance, if we're looking at homeowners insurance, the cost in some cases for homeowner replacement costs were above 10%. We obviously increases in homeowner policy and insurance and so forth have not been on that scale. It's been less than half even, but that's very high by historical standards nonetheless. So we're getting to this place where we're going to have all of these socioeconomic, this ecosystem, these transformations on our cost basis, reducibility in the short term to diversify, a challenge to the way we think about these products, personal and commercial and so forth. And we end in a place where the tide of extreme weather is rising our cost bases across the board. Can we still follow the same type of year-over-year increases in rates and still maintain the strong financial policyholder surplus, solvency, and so forth that we've had? The answer remains to be seen, but it's certainly, we are at a juncture where we have to ask the question that is this comparative cost of insurance premium, of insurance capital, the return that we provide, given the risk, given our ability to diversify, being the available data, and the spread between this insurance cost and the outright cost of lending, for example, can it stay as large or will it have to narrow? And given everything that we're looking at right now, it will most likely have to narrow. The extent of which remains to be seen. The extent of which of this narrowing will depend on our ability to think of new products, to innovate, to look at ways to diversify, and to better pool our assets. But certainly, that will be at the margin. There is a reality that the spread between these two types of capital, or outright lending and risk capital in the context of insurance, will most likely have to narrow if we want to preserve our solvency. And that really becomes a socioeconomic question. And it also becomes a social choice. Like, how do we want to address this? And this is not our position, this is not the industry's response. This is about regulators, about legislators, about folks through the political system and so on to decide where should we go as a society. And For example, how do we look at the role of NFIP? How do we look at the role of TRIA? Another example here from a different type of risk. The state-sponsored MGAs and so forth. What is their role in this context? What is economically viable from a product standpoint, from the industry and regulatory standpoint? And on the other hand, how much from an equity standpoint, from an economic development? If we short circuit the availability of insurance by not looking at some of these considerations ahead of time, we end up removing a very important tool in economic empowerment. Now, I had some projects with the IFC, the International Finance Corporation, which is part of the World Bank Group, and they invest in banking, developing banking around the world, and in insurance companies as well. Because you can't get a loan quite often without insurance. And insurance is very flexible, quite often more flexible than lending structure. And it is a key and an essential way to lift folks out of poverty, to create wealth building generation after generation, and empower people. So if we short circuit the availability of insurance in an economically viable way, or in a manner that folks can afford it, then we really end up in a situation that is challenging. And again, we know from an equity standpoint. So these questions here, we as an industry have our job to do to provide the product in the most economically viable manner and so forth. But there are these choices there. And how do we, ahead of time, look at these questions so that we can, working together, we can ensure that the pricing remains available. So the crystal ball raises all these questions that are structural. Again, remember, we do not advocate here any position. What we're trying to raise here with this presentation is, what are some of the questions? These trends have been there. We're recognizing them. There's nothing new here. All of this should ring a bell. Yeah, this is logical. We're not saying it's going to happen. Crystal ball is not magic. And this is about being generally logical rather than precisely wrong. These things are going to happen. They're happening already. If they continue, what does this mean for the product? What does this mean for the way we diversify? What does this mean for how much we're going to pay? What if we end up in the world? That's becoming, that's almost there right now. We're in a place where in Florida and other, we used to think about, I'm going to go to a low-cost state. What does that mean? Well, affordable housing. Key element of it. Well, affordable housing, traditionally on the basis of lending costs and so forth, and land. But insurance is going to be a bigger chunk of that. So if you're in some of the low-cost states are probably going to remain low-cost states, but some of the low-cost states may be more expensive solely on the basis of insurance. So again, this is not about one versus the other. It's an issue of how do we as an industry acquire the tools, the data, working with regulators so that we can provide answers, so that at the end of the day, we are equipped to understand these changes and so forth. So, and this is really where I want to kind of end my presentation and then go into the questions. But these questions and our forward thinking, again, from our perspective, not advocating one to the other, just saying, think about this, will lead to the sustainability of insurance. And folks sometimes I teach at NYU, as I was mentioning, folks sometimes are surprised, my students, when I say, hey, by the way, insurance is bigger than banking. Oh, we're all in finance, but we work very closely, but as an industry, we're bigger. Everyone gets insured. Banking, you really can't have property ownership and lend and mortgages and so forth without insurance. So there's a huge issue of equity, and insurance can be such a tool, and we know all of this. But if there's a short circuit there in that, and my final words before the Q&A are going to be, how do we go about thinking of what is an economically viable premium? How do we work with consumers to say, well, traditionally it might have been that 1%. Remember when I started the presentation, I mentioned, well, traditionally maybe we pay 1% as an example of property repair costs. Well, what if we're at 4 or 5 so that it remains economically viable? If that's what the numbers are saying. Now, there are policy decisions that may provide government other schemes and so forth. That's not what we're talking about today. What we're talking about today is just the statistics of it on its own. So I'm going to, I believe that's my last slide. Key related public policy. Again, we want to just leave you with a few more things. What does this mean at the end of the day? Well, data adequacy and granular pricing, that is the way. There are a lot of ways here that as an industry, we can address these challenges. We've done it for hundreds of years and we will continue to do so. But it's all about forward thinking and recognizing the trends right now and thinking forward. So data adequacy, hybrid products that aren't just about residential and commercial, being able to dwellings, for example, being able to get greater diversity in a new way, taking advantage of this transformation of the space and how we live and where we live to get new ways of diversification. The rate setting process, central, of course, to regulatory oversight, in a context of structurally higher replacement costs. This issue of premium repricing and commercial viability. This flip side of the same coin here. And then, of course, these wider policy issues that are for the public sphere to engage in, of relative share and role of private and public markets. And then finally, of course, all of this wrapped into solvency and capital adequacy. Because at the end of the day, we need to continue, as we have, through prudent risk management, to be able to provide the service, the product, the insurance on economically viable and sustainable. So I'm going to wrap up here for presentation part of this, and really excited, Jim, because we have a good 15 minutes there for some question.
Yeah, that's great. And as you were going through this, Michel, there were several things going through my mind, and I know I've invited a lot of the financial regulators who have either attended or will be attending our summer program that we run here for financial examiners and financial analysts. And so when you got to the solvency part, that really piqued my interest. And I mean, some of the things that you had mentioned, I might ask you, to detail on, but I'm going to ask you a bigger picture. But some of the things, the extreme weather is no longer correlated. It's correlated nationally. Okay, and I think in the past, we might have thought extreme weather, that's a state issue. Okay, that's one state. And I think that's something to think about. I think the other thing you were talking about is how the impact is on different lines of business. I think, one of the other concerns we might have had, we're looking at solvency issues, is if you got a monoline, company and, something going wrong in that line of business, that could prompt, a solvency problem. But let me just give you a big picture. Maybe you can dive into some of those, but I just, and then while the other people, hopefully give them a chance to ask questions and put that in the chat as well while we're talking. But if you could kind of just maybe weigh in on this whole idea of giving these different macro and industry trends that you've highlighted, what risk driver kind of would you single out for as a key one for long-term solvency?
I think thank you. That's a great question. And I have a student group which are looking at portfolio theory, and both a wonderful concept. We can diversify risk, and also the cause of many evil in finance, stock crises and so forth. We can divide assets, but at the core of it is this concept of diversification. And what challenges diversification is correlation. And we have found that traditionally, when we think we can diversify, things aren't as diversifiable as they can be, and that's what's happened with extreme weather. To your point, the reality is that about a few years ago, when I joined III, almost I think 5 years now, something like that, we decided to create these maps, and it's resilience.iii.org, and they were going to look at different extreme weather perils. We thought, well, isn't that already somewhere? We don't want to, reinvent the wheel here. And we found that people thought of wildfires. That's a west part of the country. That's a California issue. Hurricanes, Florida, the Carolinas, the coast, Texas, Louisiana. What we found is that there weren't any single map that said, hey, Americans, we move a lot from the West Coast to the East Coast, from the north to the south. I may need moving from California down to Florida to better understand hurricanes, et cetera, or wildfires. But what we're seeing is that traditionally, folks, companies, carriers diversified. They thought wildfire, they thought tornadoes, but now carriers have gone more nationwide. But we're also seeing that because there's more of these events, one may diversify away from wildfires, but you're picking up risk of a different type, but it's still extreme weather as a result of tornadoes. Or you may pick up a different type of fire. We know what happened in Canada a few years ago. So this concept there of diversification, and this is, in many ways, what's important about my talk today, our conversations today, is the way we diversify. We need to think a bit more about it, and we need to build the data behind it, and we need to price the impact, both negative and positive. And I don't want to say it here, I don't want to leave you with the impression that, we can't diversify. We certainly can. Tools are getting better. There's more to insure. So there's a lot of ways to diversify. We just need to think about them. And we need to think about them so that we can continue to offer the product at the best possible price with the strongest financial backing and solvency behind it.
Very good. And, I think the next question we have from an attendee is kind of probably related to, thinking about the interest, rates and inflation and how all those impact, because this question is about investment risk. So is the recent rising interest rate environment an overall positive or negative for insurers? So you see, investments can be, get better rates. That's a benefit. But we always think about bonds when we talk about the insurance industry, right? Because it's a huge percentage of the portfolio is around bonds, and is that going to affect that? So there's some potential pros and cons depending on how you look at it. But I'm just curious if you've had any research on that and where this might go.
I'm so glad. Again, that's a fantastic question, and I think it's very important. We as an industry make a narrow profit, very small in underwriting, and it's not where the bulk of our money comes from. And that's the way we've agreed as an industry to function. It allows us to provide the product in the most equitable manner, and almost think of it as a public good, which it is. Turning to the impact of changing interest rates on our returns on investments, whether it's capital gains or investment income. First, what do we have? As an industry, we have the largest pool of assets under management. We are very conservative when it comes to managing our assets. Conservative here using the sense of prudent risk management. It's regulated, there's strong oversight. The primary role of our investment is not to make money. The primary role of our assets under management is to stay in business. And so that when we have several years, 4, 5, 6, 7, 8, 9 years of negative combined ratios, where we have underwriting losses, we have this cushion that's highly regulated again, that's there to make sure that we can pay and we can meet our obligation under. So that's the first element here. It's not on one hand, you underwrite and you pay there, and on the other hand, you make money. No. The other hand is also about making sure we can pay. As a result of that, we have to be in low risk, and that means assets, and that means that we have to be in less returns. Now, we've done very well as an industry managing high interest rates and low interest rates. There are a lot of financial instruments now that allow chief investment officers and companies, insurance carriers and others, to make money in both high and low environments. Now, traditionally, it is true that when interest rates go up, if inflation goes up, interest rates go up, and it's a better place to hold fixed income instruments, which is where in the last 6 months, 1 year, we've been. And that has lifted, in many regards, our investment income. But it's also dislocated some of our asset liability management expectations. Remember, we generate income, whether through capital gains or investment income and other assets, not to make money. That is just there, and we give it back in terms of et cetera, to our shareholders. It's about making these payments and being this added solvency safeguard for the products. So there's been a lot of capital gains where we have had as an industry to sell and so forth, take losses in the short term, long term, to reallocate, and that's been dislocating. Again, what one would not want to see is the industry as a whole moving into high risk assets, getting more of a market risk exposure. market risk in the sense of equity risk. About a few years ago, we capped the industry was capturing some of this. We kept our exposure to equity as a whole around like 20-21%. There are countries in the world where 30-40% of assets under management in insurance, and it's regulated, is in equity. I don't think that is a situation where, certainly we're not even close to that, but we wouldn't want to go here because of that added risk.
Yeah, as you were talking, about this, and I would agree with you wholeheartedly on, the purpose of these, investment vehicles being, something that would, permit companies to pay, in the future. But I know the folks who have gone through this program would also be a little bit skeptical and say, yeah, but here's what we're seeing. When the combined ratios start to deteriorate, they start chasing yield and private equity and things that was hard to track down. And so I think they would agree with you and say, yeah, absolutely, this is what we need to be doing. But I think they would say, oh, we need to be cautious about that. So, hey, we have another question here. Could the stubbornly high inflation rates, which, a lot of this came from supply chain issues, continue? To what extent, is that reflected in the Fed's raising rates, here? And, he also has a question on labor supplies and how that might, affect the industry. So if you want to weigh one or both of this, yeah.
Interest rates deal with demand-driven inflation. You raise the cost of capital, therefore folks don't spend as much. You bring equilibrium to supply and demand and prices. What we've had is less so of a demand-driven inflation, but a supply-driven inflation, to the point of the questioner, and what that, both in terms of the availability of goods, products, and the availability of labor. Now, we are in a better place. These dislocations are improving, are softening, but some of these potential triggers of dislocations are very much out there. The war, issues of geopolitical risk. So we refer to it as a geopolitical premium. There's a precarious wartime equilibrium here in terms of supply and demand with food and other products, in terms of concrete binding agents, et cetera, without going into all these components. Supply chains have caught up, have adapted, but we still, things could get even worse very rapidly from a war standpoint, from a geopolitical risk standpoint, and so forth. So we cannot, and because it's supply, not demand, interest rates won't help much. It can help at the margin, but not as much. Right. Therefore, we remain very cautious about that, Yeah,
I noticed that your inflation rate was a bit different than the Fed's, inflation rate. Is that because you have like a different basket of goods for measuring that inflation, or what accounts for that difference?
Well, first we have the replacement cost basket, which is P&C specific, very different, of course, but largely based on the Fed's own numbers. If you open the BLS and the BA to get a bit technical, what we do there is that we look at those components we repair and rebuild. So for homeowners, we look at lumber, for example, and we make lumber much more important compared to that than it is in the overall CPI. 1 out of 30 components, as opposed to for a home, it's about 30% or something. But overall, our view, because of this, our view is very much what the Fed's view was originally before it started to raise rates and before it had all this political pressure, is that this inflation is transitory, except the transition is taking a long time. But transition, really from an economic standpoint here, doesn't mean time-wise. It means that it's outside of what interest rates can do, because it's supply, not demand-driven. And as a result of that, but we are a bit more pessimistic in the longer run, because of the structural consideration that I referred to in an earlier point about the generational wealth transfer and the way we spend and what we spend and so forth. And we do have 30, 40, 50 years of debt that was accumulated that's quite overbearing on the economy. And somehow that debt will have to be processed. And from a macroeconomic standpoint, inflation has somewhere to play a role in that. So that's why our long-term view is more pessimistic than the Fed in that regard.
Gotcha. Yeah, I saw on the debt side, I think it was Morgan Stanley's analysis of $2.9 trillion of this mortgages coming up in the next couple of years on this commercial real estate that, some of which have very low occupancy rates. So we'll see how that plays out. So last question, and it's something we always like to do for the regulators in here is, what resources would you suggest that they might look into if they wanted to do some of their own searching for this?
Well, I would say go to people like you, Jim. There you are in Illinois and so forth, and there's a lot of resources, and you have colleagues. It's a lot of what I've talked about today is local. It's not just state-based, and it's important to be able to not just read, but also interact with people. We all learn differently, but it's important to be able to engage, and there's fantastic universities and scholarship across the country. So that's one element. Now, if one takes a step back, at Wharton, for example, there's a risk center, a bit similar to yours. We work very closely with it as well. There is a variety of possibilities there, but I always emphasize the state level resources because we have a state level framework in terms of regulatory oversight in insurance, and it's very important to understand these dynamics at the local level. And economics, all these conversations can get very technical. And what's relevant is to translate them. So in some ways, all economics, when it comes down to it, and regulations and insurance has to be local. And when we're talking about diversification here, as a key to maintaining economic viability and equity, we need to think locally. So state level resources, at the federal level, you can go to the BLS, the BEA, just go one degree below, one level below the CPI as a whole. Just go to that one level below where you have these components so that you come equipped with that. And of course, there's the resources we have on the III and so forth. But Wharton, I've mentioned, the BA, the local universities. There's also a lot of foundations that are looking specifically at some of these issues and that do nonpartisan, highly respected research. The Pew Trust, for example, has a whole array of conversation of research on where to build, which is very important, but outside of this ecosystem, but certainly very important. So, and then also think outside of just this issue of economics, and then, the other part of my title is data analytics, and a lot of these solutions are about data analytics and diversification. But, as we conclude here, what we're talking here about is the availability of the product that is central to economic empowerment and wealth building at a very basic level. We're not talking about getting rich here. We're talking about protecting a house, protecting someone's car to get to work. These are questions about equity. This is about how can insurance provide economic empowerment, making sure that the rising tide is for all, not just a few. And as a result of that, this is an area where this analytics and so forth is very important, and being able to continue doing so in a solvent, structurally sound way is very important.
Very good. Well, thanks so much for your time here. This has been a thought-provoking session. I know that the attendees have an option of emailing. You might be doing that later on. We can also, if they have questions we didn't get to, we can email them too. We're out of time for the day. On behalf of the Institute's Griffith Insurance Education Foundation, IRIF, and the Katie School here at Illinois State University, I thank you, Dr. Michel Léonard, Chief Economist and Data Scientist, Head of the Economics Analytics Department, III, and Adjunct Professor at New York's University's Economics Department. Thanks for being with us. Thanks for everybody else for attending. Hope you have a great day. Take care.